All right, welcome to Money Club Mondays. It's May 23rd, 2022. So today we have one of our borrowers on the show. So Paul Riley. So I actually don't know Paul. So I'm going to get to know Paul along with all of you guys and introduce him to the Private Money Club and see what kind of deals he's got going on. And so if you guys are lenders, you got money, you're looking to lend on deals, either now or in the future, take notes, write down your questions, grill Paul, because that's what it's all about, right? I mean, you got to be able to, you got to understand, we always talk about the laws of wealth. You want to understand what you're investing in. You want to trust the people you're investing with. And that's what Money Club Mondays, on top of the education and training side of things, it's all about getting to know the community. Let's get to know each other as both borrowers and lenders, because it is a long-term relationship. You guys can work together for years into the future, and that's what it's all about. So Paul, thanks for coming on, man. How's it going?
It's going good. Thanks for the opportunity, Stephen. I appreciate it.
Yeah, definitely. You were the first one to reach out. I had a bunch of people reach out, but I got you on first. So we got a bunch lined up. Before I forget about it too, next week is Memorial Day. I will not be on here. I plan on being on the water somewhere. So we're knocking out Money Club Mondays next Monday, but the following week we'll continue back up with this borrower series, and we'll keep it rocking and rolling with new deals for everybody. So get those questions ready. So Paul, tell me, man, like, where are you located?
I'm outside Philadelphia, Pennsylvania.
Okay.
How about you? Where are you located? I don't even know.
Yeah, I'm in Vegas at the cigar bar right now.
Yeah, gotcha.
Yeah, no, I'm down in South Florida. So I live in northern Palm Beach County, a little area around Jupiter, Florida. So yeah. So, but Philly's a fun area. Got some good stories, but those stories are not appropriate for Money Club Monday. So if we ever grab a drink at the bar, we could swap those stories.
We can just talk about the cheesesteaks for now, right?
Yeah. So do you know Larry Steinhaus?
I don't. Mary, you do? Or
no, Larry Steinhaus is, like a affiliate partner of ours. He's come to some of our trainings, but he's real big in real estate investing and stock market training. He has something called investor schooling they do right outside of Philadelphia, and they put on some pretty cool events. We'll have to introduce you guys.
Yeah, that'd be great.
All right, cool, Paul. So tell me a little bit about, I guess, your background, what you got going on, what's happening.
Right. Well, I started in real estate full-time a little bit over a year ago. So February 2021, moved over from living overseas for about 7 years, from Sydney, Australia. And in that time, that's where I discovered, real estate, different ways to get into it. And I knew just that transition from moving over there back to here in the Philly area that I wanted to jump into real estate full-time. So made the jump, started off just wholesaling properties for 2021. Did a little bit over 6 figures in revenue in my first year. And I was like, wow, cool. That worked. I can keep doing this full time. This is awesome. And then also have switched over into real estate notes. So we can talk a little bit more about that in the future, but that's kind of where I see myself more long-term in the real estate note space. And that's what I've got for us today.
Okay, so you generated the 6 figures your first year. You were doing flips or wholesale, or what'd you say you're doing?
Wholesaling.
Okay. So for the last year or so, you've been doing a lot of wholesale deals.
That's right. And in the past couple of months, switched over into real estate notes. Still doing a couple of wholesale deals, but really what I like about real estate notes is the scalability of it, and it's a quicker path to cash flow, where that's what most of us probably are here for. Financial freedom. One of the ways to do that is through consistent cash flow every month. So that's kind of why I dove into that asset class.
Yeah, no, it's smart. We work with a guy, Kevin Shortell, that does a lot of notes training for us. And do you know Kevin?
I know his material. I haven't met him personally.
Okay, cool. Yeah,
his podcast.
Yeah, great guy, man. Really good guy. He'll actually be up at our, we're doing a 3-day training event. We're doing one live and in person in Buffalo at the end of July up at Chris's office. Nice. We rented out like a little media studio. And so we're going to do that up in July, and Kevin's going to come up and spend the weekend with us and do some training on notes. So we've had him on, we've had him on here before too. And he's been on a lot of our past 3-day trainings. So people on here might be pretty familiar with some. I know some people might have gone through his training, so maybe might be a good fit. But notes, I love it, man. Notes are a great, like you said, it's a great way to create new cash flow.
Mm-hmm.
So what kind of, I guess like that's kind of a different transition. So I don't hear that a lot, the transition from wholesaling and notes. Like, how did that occur for you?
Well, I had during that research phase, I guess that we all go through when we're about to get into real estate. I came across notes. I liked it, but I guess I didn't really have the guts to get into it right away because I hadn't done anything yet. And so I jumped into wholesaling first because the low barrier to entry and the way that you don't need a lot of capital. You just put a lot of effort into it and you make a lot of calls, and you can make money that way, which has been great. So during all that, I kind of had my eye on notes. And then after having some success with wholesaling and some experience in real estate and investing, things like that, that's where I was like, hey, yeah, that's where I see myself long term. Let me just kind of transition over into that.
Right. No, that makes sense. I mean, that's, when we talk about like the cash flow quadrant and the different areas of, working for money and having your money work for you and having things like that. I mean, the great thing about real estate investing just in general are there's so many different types of real estate you can do, like the wholesale,
Right.
like the notes, like the flipping, like the long-term, the short-term rentals, commercial, et cetera, right? And so it's
Right.
really cool to see somebody that kind of gets into it. Maybe you needed to just strum up some income and some revenue at the time doing the wholesaling, but you quickly learn wholesaling, like you're just trading hours for dollars. That's all it
Yeah,
is. It's almost like a
that's right.
job, right? And
Some good dollars, but still, like it's
yeah, no,
always on to the next deal, right?
yeah, you can make a lot of money, but yeah, you're only making as much as your next deal. Absolutely. So it's cool to see that evolution. It happened for you pretty quickly, within a year. So that's really neat to see happen. And then
Thanks.
and so you were doing, sorry, were you doing the wholesaling primarily around your local area up there outside of Philly?
No, actually, was doing it virtually. So
Okay.
while I'm here in Philadelphia, I did most, or actually all of my wholesale deals in Charlotte, North Carolina area,
Oh,
and I
wow.
wanted to do it virtually because I wanted to have that potential scalability of doing deals in any market, not just my local market. So that's why I jumped into that. And since I was moving back here from the U.S., I didn't, or so from Australia to the U.S., I wanted to be able to live anywhere and not really be worried about the local market where I was in. So for those reasons, I was like, hey, I'm gonna do this virtually, and yeah, so I've done all my wholesale deals in Charlotte, North Carolina.
Okay. Yeah, that's a great market too, right through there. I mean, North
Hmm.
Carolina's got some solid areas for real estate. Okay, so that makes sense. And then the notes you're doing, are those all over?
Those are all over. Uh, Michigan. There's a lot of different states, but I guess the main states that I'm looking at would be Michigan, North Carolina, South Carolina, Pennsylvania, um, and Texas and Florida. Pretty much, you can pretty much do it in most states. Just depends on foreclosure laws and different restrictions there. But yeah, looking at deals pretty much nationwide, which is awesome.
Okay. Okay, cool. So I'd love to get more into, notes, and maybe we can teach and educate a
Mhm.
little bit on how they work and what you look
Sure.
for and how you kind of find them and things like that. But
Cool.
before we get there, just to kind of give everyone an idea of, what you're looking to accomplish in the private money club, and, how you're trying to help
Mhm.
people, get their money and put it to work. Like, what exactly are you doing with notes and other people's money and private money, and what's that look like?
Yeah, so I'm finding a great deal, whether it be a performing notes, which is what I have for us today, or a non-performing note, which is a different strategy. But finding a good deal and using private capital to execute on that. So, like today, we can get into it a little bit later. But the performing notes, it's good cash flow. Like this is a great deal, great cash flowing deal. Lots of good numbers around this. Want to take this down and would be great to finance it with some private funding, who people that want some cash flow as well for their portfolio, but they don't want to have to go at it full time to find these deals like I've been doing, and do all the due diligence and understand all those aspects. So kind of, yeah, marrying those two things, great deals and private capital that makes sense for everybody.
Okay, so you're kind of playing a little almost, so you guys, I guess you guys would be almost partnering together, or tell me about it. Like, so how do you have this set up, or do you have notes available right now? Like, let's talk about it.
Mhm.
Okay.
Right. So it would be technically through a private lending agreement. So it wouldn't be equity partners. My business would still own these deals, you know, control the deals, everything like that. But the private funding is the capital for the deal. So, and that's collateralized by the asset. So if I turn out to be a crazy guy, I run off on you, we want to make sure everybody's protected in the transaction, right? So, um, so those private funds are secured by the real estate or by the note, and the lender, the private lender, could be a lot of you in this scenario, just gets a flat set rate of return on your money. And so my business makes everything that's above that. And you know, the more capital that's available to somebody like me, a real estate entrepreneur, the more deals we can do. And you know, like I think I've heard Chris say, it's not about how much resources you have, but how resourceful you can be. And that's really what it's all about here, and not really passing on deals because of the lack of capital, but really just you know, networking and having, and you know, working well with other people that have different strengths or different resources available to them.
Right. So almost like, some is better than none type deal, I guess, right? I mean, if you had the cash to buy these deals yourself, obviously you
Right.
make more, where if you're splitting the
Hmm.
profits with somebody, but some is more than none. And I guess
Absolutely.
if you add up enough of those, I mean, it's
Hmm.
very similar to what we do with the infinite banking concept, because we do these specially designed and engineered whole life insurance policies. But to be able to give the high cash value and everything that we do, we give up, 70%, sometimes 80% of our commission that typically we could make
No
off
way.
of designing these policies. But we do a lot of them. We do that for the benefit of the customer, the client. And
Hmm.
so, we work off the volume. So it's kind of similar to that. I mean, it kind of sounds like, but anyway,
Absolutely.
so just to take one step back real fast, Jim was just asking, can you explain wholesaling? So Jim, just real easy. It's going out and basically finding a deal, putting a deal under contract, but before actually moving forward and closing on that property and doing all the work yourself, whether it's a flip or whether it's a short-term or long-term rental or whatever the case might be, you are taking that, basically the contract, the paper, and you're selling that to another investor that does want to step in and do the whole rehab or whatever the case might be. So it's kind of a, wholesaling is real big on marketing and negotiation, because you got to be able to
Yeah.
market to find the deals, and you got to be able to negotiate to get that deal under contract to make the numbers make sense, where
Hmm.
you can make a little bit of money. I mean, your typical wholesale deal, you're typically going to sell for $5,000 to $10,000. I mean, Paul, is that what you were kind of seeing?
I was a bit above that in
Okay.
my market. So my average deal is about 17,000 per deal. So, but
And that's
yeah, it
excellent.
ranges.
It's been a crazy market. So
Yeah.
I haven't
And
wholesaled in several years.
right. And what's been awesome, I guess, in the last year or so is connecting with hedge fund buyers. So like those guys, and the way the market's been, like sometimes what they'll pay for they have a kind of a small box, but sometimes what they'll pay for the property is ridiculous. So, you know, I really took advantage of that, where getting a good deal under contract, then you can offer more to the seller because the hedge fund is offering a ridiculous price, and it just kind of, you can push it more, working with investors that way. So um yeah, that has been my experience.
Yeah, I mean that's all wholesaling is, Jim. So
Yeah,
just
flipping
it's a
contracts.
yeah, it's a great strategy for someone that wants to get into real estate investing and learn the front end of the business.
Hmm.
Maybe they don't have a lot of capital right now getting started to like do a full rehab or flip, or maybe they just don't have the contractors in place to do that, but they want to, get into the business. It's a great way to get into real estate investing without having to deal with all the headaches of real
Sure.
estate investing and make some quick cash. And
Hmm.
so it's a cool strategy. I actually buy, I would say the last dozen rentals I bought over the last several years have all been purchased from wholesalers. So I don't have a marketing in
Hmm.
place anymore or anything like that. So I just buy from the wholesalers, because at the end of the day, as long as the numbers make sense, that's all that matters for an investor. So if
Yeah.
somebody like Paul goes out and does all that work, I'm going to make 50 grand on the deal, even paying him a $17,000 assignment fee, then why not? Right. It's saving
Yeah.
me a ton of time and money. So it's a cool strategy, but I love how you've kind of, taken that and turned it into what you're doing notes. So talk
Hmm.
to me. So like, what kind of notes do you have some available right now that you're looking to close on, or what do you got going right now?
Absolutely. I don't know if it's helpful. I did make a little presentation of some of the stuff on it. Should I share
Yeah,
my
that'd be
screen so
great.
everybody can see that?
Absolutely.
Okay, awesome. Give me one moment here. Okay, cool, cool. Awesome. Yeah, so I can kind of went through over this. Oh, this is me. I live outside of Philadelphia, Pennsylvania. We're doing notes, which is awesome. Um, I guess so. What I'm doing today is I'm not selling these notes, and we kind of talked about this already. I'm looking for a funding partner, or somebody to bring the capital to these. So maybe you can put it in the chat. Who has money sitting in an account ready to go, but it's making nothing? Maybe it's a savings account, or maybe a self-directed IRA, which are great, but hey, you haven't deployed it yet, and it's making nothing. Anybody kind of in that scenario?
Yeah, so we have a lot of so a lot of people on here, Paul, just so you know, a lot of the lenders, I would say the majority of the money is coming either from the infinite banking policies, the money
Okay.
multiplier policies, or from self-directed IRAs. I would say those would be the primary pools of where money are coming from. There's some cash and some savings in typical
Mhm.
accounts, but I'm gonna know anybody that's doing that. Let's get that money into some kind of advantage vehicle,
Yeah.
like a infinite banking policy. But I know that not all of it, but that's where most of it's coming from, just so you know.
Okay, gotcha. Cool. Sounds good. So this will be kind of a good deal for you potentially if you have funds ready to go, but you haven't deployed it yet. How long has it been sitting there? I don't know, maybe a year, 6 months, what have you. So right, like I already mentioned, not selling this, looking for a funding partner, and this is going to be a pool of performing notes. And performing notes mean they're cash flowing every month. It means they're paying every month, and the money's coming in. That's why it's called a performing note. And I think I saw somebody in the chat ask a little bit about what notes are. Is it okay if we go over just kind of the basic concept of notes, Stephen?
Yeah, that'd be great. Perfect.
Okay, awesome. So real estate notes are debt that's secured by real estate. So here I'm not buying the real estate outright itself. I'm buying the debt that's protected by the real estate. So instead of collecting rent like you would on, say, a rental or some other type of real estate, say commercial or whatever, here I'm collecting the mortgage payments or mortgage interest. So what I've discovered a lot when I talk to people and I say mortgage, it's like everybody knows what a mortgage is. Like maybe either you own your house and you're paying your mortgage, or you own some investment properties and you're paying your mortgage that way. Anybody here have a mortgage? Everybody knows what that means, right? Well, with notes, and this is probably the trickiest part for a lot of people, we're getting on the other side of the equation. So when I say we're buying mortgages, we're buying it from the bank or someone that's in a similar scenario as the bank. So we're not paying the mortgage anymore, we're receiving the mortgage payment. And that's how we make money in a lot of these scenarios. And because of that, because it's a paper asset that's backed by a real asset, there's no property management, there's no repairs or tenants. Is this making sense so far to you guys? How are we doing, Stephen? I don't want to just blow through it.
Yeah, good. No, I mean, just, it's, I think probably everybody's pretty familiar. I mean,
Okay.
it's, you know, a note is just a mortgage. I mean, essentially. So
right.
Banks, when you get a mortgage, like they don't keep that mortgage. They always sell it off to somebody. So, and this is a whole industry that people go and buy, and we'll get into we'll get in a minute about performing versus non-performing and different ways to buy them and things like that. But that's all we're talking about here is mortgages. So Paul's just buying mortgages essentially. And then as somebody makes their mortgage payments, instead of sending it to Wells Fargo, it just now goes to, Black Arrow Assets that owns the
Nailed it.
So that's all.
Cool. Awesome. So let us know if you have any questions on that in the chat. So I guess we can move on to some of the deal overview. So here's what I've got today. Looking for funding today. This is a pool, which means just a small pool of performing notes. So it's 3 performing notes, meaning all 3 of these have been making their payments on time every month for the past year or 2. So looking at some of the stats here, the summary. So this is just kind of a total summary of the pool. The as-is property values of these three together is about $283,000. The balance, so it's a mortgage, right? It's debt. So the balance owed to me when we close on this is $213,780. So about $214,000. That's the balance that's going to be owed. Now I'm buying this for 153K. So I'm buying a balance of 214 for the price of 153K. It's like crazy. How can you buy $100 for $70? Well, that's one thing that's awesome about this asset class is that you can buy them at a discount. Why would somebody sell it at a discount? Well, I can tell you with these notes specifically were originated by a note investor and a flipper type guy who found these deals maybe a year or two ago, bought them really cheap, fixed them up, and then instead of just selling them out, right, like a normal flip, he collected the down payment and originated these mortgages. So for the past 2 years, he's been holding these paper assets and has been collecting the income that way. So the guy selling these to me, he's not losing money by any means. He just has a different model of business, if that makes sense. So is that making sense to everybody so far as how that goes?
Yeah, I mean, essentially, it's somebody that's a real estate investor. They went in, they purchased the home real cheap, they put the work into it, and were able to sell it at a much higher value. So they don't have very much into the deal. Now they have this mortgage for much higher value with interest coming in, and they want to cash out of that thing, but they can cash out at a lower price, making it attractive to somebody like Paul to purchase it because they're still making money because they were able to buy it so low originally. So it's a great strategy. It's seller financing essentially.
Yeah, that's exactly right. So I guess we'll go over a little bit more about the mechanics of the deal here. So total LTV, which all that means is loan to value. So the amount of the balance compared to the value of the property is 76%. Basically, that just means that gives the borrowers in these scenarios more incentive to stay on track. They don't want to lose the property because as it stands right now, that's their equity. So they don't owe that 283 to me. They only owe the 214. So that doesn't come into our pocket directly, but that puts us in a safer position because the borrowers are more invested in the property. The total investment to value, so the total cash into the deal versus the protection of the real estate is 54%, which is, in my opinion, really awesome. So just to summarize what that means is we're in the deal for 153 and the value is 283. So if these notes go non-performing and we have to foreclose, there's a really nice cushion of equity that protects us in I guess that bad scenario. I don't really want to get the properties. I really just want the payments on time every month. But if we have to, I'm ready to take the properties back and liquidate that way. And that's probably one of the biggest elements that you want to look at in these note deals. It's like, how much are you in the deal for? And in the worst case scenario, which is foreclosure, where do you stand there? So let's just say the property value is only worth 200,000. Let's just say my as-is comps and we'll talk about this later, but use local realtors to verify the value of these. If I'm $83,000 off here, we're still only in it for 153, and the property say it's only worth 200,000, and we're way off. We're still protected there, and we'll still be profitable actually. So even if they stop paying, it's still going to be a profitable deal, which is what we want. Okay, so moving on. The pay history. Another really important thing here for notes is what's their track record been like. So the youngest note on here has 10 months of good pay history, which means for the past 10 months, they've been paying. The oldest one, 20 months, meaning same thing, they've been paying for 20 months. And that's really important because that indicates to me as the investor, they're going to continue on that path. There's not really nothing indicating that they've been paying for 2 years. They're not going to just all of a sudden stop and go crazy on me. It's just that shows the track record shows a solid performing note. The cash flow, so all the payments, principal and interest put together, 1928. That's the monthly cash flow there. The terms of the note, 2 or 30-year terms, one's 25. Really, what's nice about that is with the longer terms, and you may know this if you have a 30-year mortgage on your personal house, is that there's a lot more interest in the payments. So I like that a lot because there's more money because it's a longer term, and the interest rate on these notes. So this is the interest rate of the notes themselves. So the paper that was originated, the mortgage that they're holding, they're all 10% interest. You might think, dang, that's super high. Why is it 10? Like 2 months ago, it was like 2%, right? At a normal bank. Now they're going up. So we'll see what happens. Whatever. We don't need to go and talk about interest rates. But the reason why these have a high interest rate is because this isn't your typical mortgage. If these homeowners or one of them's a duplex, so they're an investor. But if they could get traditional financing at 2-3%, they totally would. But for whatever reason, whether it's credit or they've got too many loans, so the bank won't give them another loan, whatever it is, that's why they're in an agreement like this. And that's why the interest rate is high. Makes it a little riskier. Bank of America isn't holding notes with 10% interest rate. But that's where, the boutique investor like me can come in and we can kind of fill that gap in the economy. So thoughts, Stephen, how are we doing on that? Is that anything we need to clarify?
Yeah, if somebody wants to own a home and they can't qualify traditionally for bad credit, for lack of income, for like provable income, like maybe they're an independent contractor. There's a million reasons why people can't qualify for traditional financing, but they still want to own a home, and that's why you see a lot of seller finance deals, a lot of notes like this that are out there around the country, and it's very, very common for it to happen. Now, my question, I think I know this answer, but maybe you know better than I, Paul. Now, if one of these people, let's say in 3 years from now, they in a position where they can qualify for traditional financing, can they go refinance that property and then like a traditional bank would just pay you off? Is that how that works? Is there any prepayment stuff that's built in there, or what's that look like?
No, that's exactly what would happen. So that would be a knockout scenario for me. For me, or if you want to be a funding partner with me, it'd be a knockout scenario for us. So what happens is, let's just say, we'll just stick with these numbers. Let's say all three refinance, say they work on the credit or they get a W-2 job or whatever, and they can refinance with a traditional bank. We get cashed out, not at the 153, we get cashed out at the 114. So let's say 2 years from now, the balance on these is 210 or something like that. Now we're getting fully cashed out at the 210. That's an awesome payday on the back end. I'll take that all day long and put it into some other notes. So that's another thing we can do is, like, when we make relationships with these borrowers, we can encourage them to refinance and be like, hey, this is better for you, lower interest rate, awesome for me, I get paid out. So if that's a very real conversation that can have with the borrowers and help them, and it's a win for us.
Yeah, maybe. You look at it, there's a scenario that plays out in the next couple of years where a 10% interest rate is low, right?
Yeah.
That'd be
interesting.
That'd be pretty wild to see, but you never know, man. I can see it happening. So yeah, no, that makes a lot of sense. That's what I figured would occur. But okay, so these three performing notes, it's a little pool. The guy that owns them now is selling them, all three of them together. They're all the same person. Is that right?
Right. That's
so
right.
You're looking to purchase all three together for 153.
Right.
And all right. So tell me, so what do you, so keep going. Let's keep rolling.
Cool. So here's continued slide. So the funding opportunity. So I'm looking for a private investor or a funding partner to come with the 153. Now, nobody wants to be married to me for 30 years other than my wife. So even though there's a 30-year term on these mortgages, we're not going to be in the deal for 30 years together. So it's a 12 to 24 month timeline where it's just a cash flow play. There's not a huge value add here. So this deal is a lot different than a flip where we're really pushing the ARV. Really, we're just buying these assets at a good price, protected by a lot of equity, and we're going to collect the cash flow for the next 2 years. Your annual interest rate. So as a private funder, you would get 6% annual return on your money, and just mechanics of it, the quarterly cash flow that works out to be $2,300 a quarter, and no work involved for you as a funder. And the total investment of total funds, like we said before, it's 153, and that's protected by 283. So during all of that, my business, I'm doing the due diligence now. I'm doing all the managing of it. So I'm keeping an eye on the performance of these things. If you have to foreclose, you have to liquidate. My business is doing all that. My business still owns these notes, but the notes, the assets, are the collateral to you as the funding partner. So, like I said, if I turn out to be a crazy guy, we have the paperwork ready to go where you can take over, and if they're still performing, you can just collect the payments yourself. This is nightmare scenario, guys. This is if I ghost you, that you want to make sure you're protected. I want to make sure you're protected. I want to make sure everybody's comfortable here. So do you have any questions about that? Or let's see.
So what happens in 12 to 24 months?
Yes, the exit. I've got, we can go to this, don't worry about the slide. So there's a couple of scenarios that we can do. One that's always there is sell the asset. So 24 months from now, I can turn around and sell the asset to another investor. How do I know we can do that? Well, typically, and especially in this market, performing notes go for about 80 to 85% of UPB, or unpaid balance. So the balance of these was 214. Typically, they go for 80% of that, 80 to 85. I'm buying these in a range of 65 to 75. So I'm buying these at a good discount. The interest rate on the note itself is being so high, being 10%. The balance isn't going down that much. So, and especially being younger loans, we can turn around and sell those, get our full principal back, plus a little gravy on the back end 2 years from now. That scenario is always there. We want to make sure we know how to exit the deal if we can. Another scenario is, for me personally, I'm working on building up a portfolio of these. So 2 years from now, I might want to cash you out as the funder and just hold it for my personal portfolio. So that's a very real scenario we can do. Another one is if you as the funder and you feel comfortable with this asset class, you feel like you understand the aspects of it, things like that, then we can talk about you taking over the notes for your personal portfolio and holding them that way. So there's multiple ways to exit the deal, but we can always sell them. And we want, as we know, we want to know how to get out of the deal. That's always an option here.
Now, if let's say let's say in 10 months from now, somebody stops paying, or you have to foreclose, or even on the other side, they refinance it and cash you out, maybe, at full price. I mean, is there any extra for the lender, or is it they're going to get that 6% annual interest paid quarterly and then their principal back? Like, are you giving them any like extra on the back end if you make extra off of selling it for more or something like that? Or like, what is there anything in the contract like that, or is it just straight to 6%? Is there any, I guess the question is there any potential for more upside outside of that?
Yeah, there's potential. I mean, I'm happy to talk about that. I'm more just typically set these up where it's just the straight principal, and the interest obviously continues to accrue. So if they stop paying and take 6 months to liquidate the asset, then you keep getting that interest. So that interest will always continue to be there, and then the principal is paid out. So that's how these are set up. If it's a deal breaker for you, then I'm happy to we can talk about a little bit of incentive on the back end. But with this deal specifically, there's not it's not like that's not the fun part of the deal.
Right.
So we can include that in there, but the main thing is just the consistent, steady cash flow, backed by lots of equity.
Right. Okay, cool. Yeah, Cindy on here was saying, how do you determine the risk in this inflationary time? Basically you're looking at, 283,000 value in this market right now, buying it for 153, so 54%. So what that tells me is the value of these homes could fall by 40%, and you're still ahead of the game, right?
That would be crazy, wouldn't it? Like that's a big drop, isn't it?
That'd be a large, that'd be a large drop. And these are the kinds of homes that are not the multi-million-dollar homes that you see a large drop in when things do pull back. These look like affordable housing homes, and so those types of homes, maybe they come down a little bit, but typically, in past they maintain, because again, people downsize and still have to live somewhere. You said one of them's a duplex?
That's right. The Pennsylvania one's a duplex.
Yeah, so it's even better. Now, is that duplex, is that a single mortgage, or are those two separate mortgages on that one?
Single.
Okay.
Single one, same borrower. So the borrower, they rehabbed it. They love it as a as a property for them. So that's another scenario. If the borrower for that one stopped paying, then can foreclose and just keep it as a rental. You could do that with any of them, but you can just turn around and collect rent on the duplex if the borrower did stop to pay for whatever reason.
Yeah. Okay. And then, so how can we talk about the paperwork for a minute? So,
Sure.
So right now, like, these properties all have a mortgage, a promissory note, that right. You're on, right? Your company's on. You guys, you will own it once you purchase it. Okay. So you'll have that. And then, so what's the paperwork look like for the lender that's lending you the money?
Right. So between me and the lender, we would make a private lending agreement. So that's between my LLC and if you're using an LLC, or you or whatever, make a separate private lending agreement between us. So that'll tell all the terms, just like we have here, 12 to 24 months, 6% interest rate, what the collateral is. So we can put all the terms there. And happy to get creative with it too. If there's certain things that are really important to you, we can work it out. We can get creative on that side. And then as far as the collateral goes, this is kind of a common question, I guess. So my business is going to be on the asset, right? The note itself, that's going to be my business. How is the lender, how are they protected? Well, what we do is, before closing, is create the paperwork. So it's called an allonge and an assignment of mortgage, which are basically the paperwork that you need to transfer the note from my business to yours. So we'll create that paperwork saying these notes from Paul's LLC to you, the lender, and I'll sign it. You don't have to date it yet, but that's going to be kind of a blank check in your hand. So I'll send that to you. So you'll have the collateral. You'll have the ability to transfer these notes over to yourself in case I default. So let's go nightmare scenario here. 6 months into it, I turn out to be a crazy guy. I ghost you. You're not getting any of the cash flow or anything like that. You declare that I've defaulted on our private lending agreement. What you can do is you can take those documents, the assignment of mortgage and the allonge, you can take that to the county of these notes and record that. That'll transfer it over to you. So then you can either collect the turnaround and start collecting the payments yourself, or if you have to foreclose, you can take the foreclosure route. This isn't going to happen, guys, but this is the worst case scenario on if I default as a private lender. And I think that covers it. So basically, paperwork allows it to be transferred over to you. You don't have to sue me or anything. You can just go to the county right away, record it, and then you have you have the collateral there. So that's that scenario.
Yeah. Okay, cool. So if somebody was interested in doing this, go ahead and funding this 153,000,
hmm
what does that look like? Obviously, they're going to call you. You guys are going to, just confirm the terms, the
Yeah,
6%, the 12 to
sure.
24 months, all that good stuff, the quarterly payments, and then what happens from there? Like, what's that look like?
Well, we're going to be closing on this June 8th. So would love to talk with you this week. If you're interested, let's go over the details together. I'll give you more info than what we showed here. Obviously, you don't want to be just going through legal documents on the webinar here, but we can sit down, we can go over each individual asset, can go over all the due diligence together. And what that would look like is us getting together the private lending agreement. And I think I saw Mark, you said in the chat who writes the contract. I'm assuming that's the private lending contract. I have a template that I use that's been reviewed by an attorney. So you can take that. You can have your attorney, your own attorney review it and make sure it's all good there. The note as well has been reviewed by an attorney. But back to the mechanics of getting the deal done with me and a potential private lender is we'll get the agreement together with you and I. Then we'll wire the funds for the purchase. So on June 8th for closing, private lender can wire those funds to often use a title company. In the note space, don't always use a title company because it's paper assets is a little different, but basically take that 53K, buy the notes, and then we're off to the races. My business, we start collecting the cash flow. You as the private lender, you start to receive the quarterly cash flow yourself. So was that specific enough, Stephen? I'm not sure if I rambled on a little bit there or.
Yeah, no, I think so. I mean, unless anybody has any other questions, Mark was just saying who writes the contract. You clarified that. It was looked at by an attorney already. You can always have your attorney look at it as well.
I'll answer Cynthia's question here. Is the interest rate compounded? So it's an annual interest rate. So it wouldn't be compounded. So it'd be 6% each year. So if we're together doing the deal for 2 years, it's 6% each year. And it's different than, this is an individual asset. So it's not like a brokerage account where it's like the interest is I'm buying more assets with your interest. That's not really the setup here. It's one asset that's paying the money each month. So if I were to, I can't buy another note with $2,300 and get that working and get you more interest that way. So that's the reason why it's not compounded. I did have a slide here that kind of goes over how we do the due diligence on notes. Would that be helpful, Stephen,
Yeah.
or should we look at some other stuff?
No, I love it. Let's do it.
Okay. So with notes, or especially with me, I'm not a DIY operation. So I utilize professionals, people that have been doing these deals thousands and thousands of times to do the heavy lifting. So that looks like title search. So want to make sure that the title is clear, that there's nothing else that is on the property that could jeopardize the deal because it is debt. So we want to make sure that we're number one and we're collecting. There's nothing else, clouding title or anything like that. So that's really important. Having a real estate attorney review the paperwork. So that's really important too. I always have an attorney, real estate attorney in that state or that region review the contract. So I'm asking them, is this compliant? Like, is this a legit contract? Like, am I actually going to be able to foreclose on this mortgage if I have to? How long would that take? Real quickly on these notes, it's about 6 months or less, which is really quick. Other states like New York, New Jersey can take up to 2 years to foreclose. With that time frame, often a lot of times that can kill the deal. So that's another thing that really helps us here is that we can move quickly if we have to foreclose. don't want to foreclose, don't want to. Rather, we just get the payments each month. But we want to know that if that happens, then we can move quickly and the deal will still be profitable. So having an attorney review everything. Using local real estate professionals to verify the property values and get current pictures and get comps. So this is what's called in the industry a BPO, a broker price opinion, which is really where a local realtor goes out and they take pictures of the property as it is. Google Maps is awesome, but sometimes it's a year old, 2 years old, 3 years old. When you're investing money, you don't want to just be relying on that. You want to make sure the property is there and that it looks good and it's the value of what you expect it to be. So that's really important. And utilizing a local real estate professional. So since I'm buying these in lots of different states, I can't be an insider expert on the market for every market ever. I look at my own comps. I do my own research, 100% do that, but I want to lean on somebody local that really understands the values of the property, and we want to make sure that that's legit and what we expect it to be. Another big part of the due diligence is reviewing the pay history. So looking at the payments that have come in already. Are they always on time? Are they late? Is it performing, non-performing? In this deal, they're all performing. But that's probably one of the biggest indicators of how the asset will perform down the line. If they've been paying for 2 years straight every month, that's a really good indicator they're going to keep performing and that this is a performing asset. The last, or I guess one of the big things here is utilizing a loan servicer. What's a loan servicer? Think of it as a property manager for the loan. So these guys are collecting the payments directly from the borrower. They're a licensed debt collector in the state. So that allows me as an investor to stay compliant and to make sure that all the boxes are ticked, everything's going well. They also handle a lot of the admin. So they're keeping track of the amortization schedule, payments come in. They also do borrower outreach. So they can get on the phone with the borrower and, work things out that way. Also, taxes and insurance. So the loan servicer, and I use Kobe Financial, they're a really great servicer. They hold the money in escrow for taxes and insurance. So we want to make sure that stuff is getting paid, getting paid on time, and there's funds ready to go for that. That kind of covers the main elements of due diligence. How are we doing on questions? I think I saw a couple. Steven, anything you want to jump in on, or?
Yeah, we have a couple questions coming in we can hit. I mean, I think what you were just saying is important. So that's all good stuff. I mean, John is just saying what's a minimum investment as an investor. So I mean, in this case, you're looking to fund the 153,000.
That's right.
So in this case, John, it'd be, the 153, just looking for one investor to come in with the 153 and partner with them essentially on, this deal for the next 12 to 24 months. Now, I'm sure, Paul, you're constantly looking for more notes and pools of notes and things like that, right? So, if you don't have the 153 right now, but you're interested in this type of passive investing and partnering with Paul, what I would do is I would reach out to him, over the next week or so and say, hey, Paul, unfortunately, I don't have 153 right now, but I'd love to build a relationship. So when you have other notes here in the near future, maybe we can do something at that point. Does that sound right, Paul?
That's exactly right. I do have some other stuff too in the pipeline as well. So yeah, this one we'll love to do, just fund the full 153 with one investor. If I have to, then I can split these up because the 3 individual assets can fund each one for about 50K each. But really for this deal, really would love the 153K. But I think for this type of deal, the minimum amount is going to be around that 50K range. So maybe 30, but around the 50K range is probably what will work best for this type of deal as far as the minimum amount goes.
Yeah, that makes sense. Chris was asking, how do you go about building up real estate lawyer contacts in each state you do business in?
Referrals. So like if I know somebody that's done business in that state that I know, I'll be like, hey, like, do you have a real estate, do you have a recommendation? Get recommendations. You talk to different attorneys in the states, and you can do interviews, things like that. But typically, I just go off of what other seasoned investors are using in that state, and find an attorney that way.
Okay. These are great questions, guys. So keep them coming. So Freddie was saying, do you get a lender's title policy or is it necessary?
It's not a deal breaker, but you totally can. I don't have it for these, but it's nice to have. Basically, the lender's title policy is an extra policy that protects it. However, with these, these are what's called a land contract or a contract for deeds. So my company is technically on the deed for these, and that also makes the foreclosure a lot quicker. So there's not as much of a risk there. So, but that's part of the title work. So I want to make sure that everything's clear, everything's good, and having an attorney review the paperwork to make sure everything's legit and functioning properly.
Yeah. Okay, perfect. All right. I don't see any questions. Keep rolling through this thing.
Cool. Let's go over some pros and cons. And there's not a perfect investment. Everything has a little bit of hair on it or a little bit of risk. So some of the pros of this deal is lots of equity protection. That's super awesome. I love that about this deal. It's a really just solid, conservative deal. And maybe that's not a fit for everybody, may not be a fit for every investor. But if you have maybe a lower risk profile, then I would encourage you to reach out. Let's chat. This could be a good fit for you. Another pro, consistent pay history. So I think I've said it a couple of times, but they've been paying on time every month for the past 2 years almost. That's a really good indicator that's going to continue. In this deal specifically, the risk is spread across 3 assets, especially if you fund the full deal with me. Just added, each one stands well as a good deal on its own, but it's just an added pro. Quick foreclosure time frame. Like I said, with these deals, can foreclose in about 6 months, maybe less, which is really good in this space. Texas is like 90 days, but other states, I think I may have mentioned this already, can take up to 2 years. And if you're not making any money for 2 years, and you have to get the property back, a lot of the times that equity margin is kind of eaten up in that time frame, because you might just break even at that point, or maybe even lose money. So having the quick foreclosure is really, really important. Reliable cash flow is another pro of this. Cash flow play, you like cash flow, they're paying every month. It's all coming in. That's a great pro of this deal. Cons, the borrowers often have a below average credit. So that's a risk there. That's why the traditional bank didn't do this deal with them, because they don't fit their perfect borrower profile. So that's a risk. How do we mitigate that? Well, I think the biggest thing is the pay history. If they've been paying for almost 2 years now, that shows that they're not only financially invested in the property, but that they're emotionally invested in the property. They want to stay there. That's something that you don't get a lot with just your typical tenants. It might be 6-month year lease, and they may not take care of the property as you would as an owner. Whereas for the owner occupied notes in this deal, it's their house, it's their home. They want to live there. That gives me as an investor the extra protection, extra benefit. Another con about notes is the appreciation. That money doesn't come directly into my pocket. So though the property may go up over time, that's not necessarily turning into a payday for me as a note investor. It indirectly indirectly benefits me because it gives the borrower more of an incentive not to mess it up. It gives them more of an incentive to keep paying, to stay in the property because they think, wow, look, I've got all this equity. I don't want to lose it. I want to keep this house. So the appreciation, like you would, like from a typical real estate deal, that doesn't come into our pocket because we are holding the debt, right? This is a debt deal, and we get the benefits of not dealing with toilets and termites, but on the other side of that is we're not getting the appreciation either. So those are kind of the cons or the downsides. Let's talk more about risks. And Stephen, feel free to stop me anytime if we need to stop.
Looking good.
So risks. Let's go worst case scenario here. What's a bad scenario in this deal? One is borrower stops paying. What happens if the borrower stops paying? Well, we can foreclose on the property, take 6 months or less, and the property is worth a lot more than what we put into it. But that's a risk. The borrower can stop paying if they put up a fight in legal, or if they maybe they get mad and they start kind of messing up the property. That's a risk as well. People are unpredictable, as we all know. Another risk is, what if we take the property back and it's worth less than what we expected? What if I was wrong on that 283? It's totally possible. We don't always get on the inside of these properties. Now, as you all saw before, there's a lot of margin there. I use local realtors, local real estate professionals to verify the values, but that's a risk. What if it looks amazing on the outside, but you take the property back and it's just completely destroyed on the inside? It's a real risk. I'm not gonna sugarcoat it. That's unlikely in this scenario because it's performing notes. So they've been paying, they want to be there. That typically happens a lot in non-performing notes, meaning you're buying the note when they've defaulted and they haven't been paying. So still could happen with a performing note, but a lot less likely. Like I said, don't always get to see the inside of the property. It's a risk I'm willing to take with these margins, but that's definitely an element to keep in mind.
And one thing to add to that, Paul, there's a lot of government programs that help people that get behind on their mortgages and things like that. And you, as the mortgage holder, if they were to take advantage of one of those government programs to catch them up or pay for future, those payments go directly from the government straight to your company. So you guys are still mitigating that, even if something was to occur, if that person was to go that route. So there's other, things that can happen too.
Yep, absolutely. And there's lots of different ways to work this out. So just really a snapshot of the deal. But if somebody stops paying, my first reaction would be to keep them in the property. Always want to work something out with the borrower to keep them in the property. So if it's we need to say they got behind a little bit, if we need to add some of that that they got backed up on, if we need to add that to the back of the loan and they're able to continue to keep paying and stay on the property, that's what we go for. Like, our number one thing is we want to keep them in the property, and really all we want is the payments, but we're ready to go to foreclose if we have to. So some more mitigation things. We want to make sure there's a strong pay history, make sure there's a low investment to value. So in this scenario, it's 153 is the total cash in, and it's backed by 283 of real estate. So that's probably the best risk mitigation in this whole thing, is that buffer there. Another one is insurance. So these properties have property insurance, which is paid by the borrower. If they don't pay it, then have the ability to declare default. It's part of the agreement. Not going to be my first reaction, like I always have been saying. Want to keep them in the property, but the insurance can protect us from things like vandalism, weather, acts of God, things you don't expect. There's a level of insurance there, which helps mitigate those things. Let's see here. Exiting the deal. Already talked about that, but if you just joined, always can sell these assets. I bought them at a good discount, and super confident that we can always sell them if we want to want to cash out of the deal.
And one thing, Paul, nice on that with you is
Sure.
your background is wholesaling. So
Right.
knowing how to move those properties if you need to is a big advantage.
Nailed it, Steven. I love it. Thank you. Yeah, that's right. Always can sell the assets. And the reason why we can is because there's a high interest rate and it's a young loan. So there's a lot of interest in the payments built in the beginning. So because of that, the balance, that 214, that's not really going down that much in these early years. So that's the plan. Collect the cash flow for the first 2 years, really squeeze out the juice, which is awesome, and can turn around and sell it again. Or I might want to cash you out and hold it for my personal portfolio. Personal goal of mine is just to keep building these up. So 1-2 years from now, can cash you out and then just hold it for myself. Or we can talk about it if you, as the funder, you like this asset, you've seen how it's been performing over the last year or two, then we can work something out where you can take over the asset and keep it for your personal portfolio. One other thing I wanted to mention about the private lending agreement, I keep saying 1 to 2 years. I would prefer 2 years, to be honest, because it's just a cash flow play. It's just going to be steady and consistent. However, I understand that might be maybe longer for some people. So we can totally work something out where, hey, we can evaluate at that 1 year mark. And if you want to be cashed out at the 1 year mark, we can totally get you out of the deal if you have other business opportunities or whatever, and you want to do that. So that's why I keep saying 1 to 2 years. I prefer 2 years because it's just a cash flow conservative deal that will continue like that. I think we're nearing the end here. So here's kind of a summary. Next steps: funding amount is 153. You can partner with me for a year or two. Quarterly cash flow, 2,300 per quarter. Your annual return is 6%. So let's talk about the return for a little bit for you as the capital, the capital provider. Might be lower than what you might get on funding some other deals. The reason for that is because it's so, I don't want to say no risk, but it's such a conservative deal with that 283 backing the 153. That's the reason why. It's not a huge value add play. So it's not a flip. There's not going to be a huge check on the back end. We're just collecting the cash flow throughout, and it's just a reliable, conservative deal, and that's why it has a lower return. So this isn't going to be like your move the needle deal. This is like, say you're invested in some other stuff that is risky, or maybe it's performing well for you, but you want to diversify either your private lending portfolio a little bit, or your portfolio in general, and you want somewhere to put some more safe money for a year or two. This is kind of the deal for you. If you have deals coming across your desk where you're making 20%, 15% all the time, you should do those. You should do those. Do those deals. This is for somebody that has money, and either they have a lower risk profile or they just want to diversify and jump into something that they know is going to be reliable. That's what this deal is. So much better than 0% or sitting in your SDIRA.
Yeah, much better than a 35% dip in your in the stock market. So
yeah,
because
sure.
I mean, we talk about a lot. It's consistent, predictable income. I mean, these are performing notes, so they've been paying for the last 10 to 20 months. With the equity and what the values of the homes are, the people would be silly not to continue making those payments. Obviously, I mean, it's right in line to the interest rate. I mean, there's a cap fund right now that Chris and Andrew, we've been talking a little bit about, and I think the 1 year investment in that is 6%. It's up to 10 if they go 3 years, but again, that's longer term. So for the 1 year, I mean, you're right on with that. That's also more conservative, around a 65% loan or investment to value. This is, you guys, what they're doing, this is, right at 54%. So it's very, very conservative from that standpoint.
Right.
So yeah, I mean, so the 6% is right in line with that kind of investment and that type of time frame. So yeah, it's perfect.
And you might know more about this than I do, Stephen, but aren't REITs are supposed to be real estate backed paper assets similar to this, but they pay like 2-3%, and traded on the secondary market, right? So those REITs, even though they're supposed to be backed by real estate, those go up and down all day long and pay a really low yield. You could think of this as like a really high performing REIT where 6%, double what your typical REIT does, and it actually is backed by the real estate. So something goes wrong, it's like you as an individual will be protected by that. That is not going to drop to zero like something that's traded on the stock market. And it's a certain type of product. It's not fit for everybody, but there's definitely a need for it out there.
Yeah. Absolutely. So if anybody has any questions, throw them in here. We're winding things down here. I guess, one question, maybe you could just talk briefly about, Paul, but how are you finding these notes? Like, is this the relationships that you have? Is this software? Do you have you don't have to go into specifics, but just generally speaking.
Yeah, there's a couple of places where you can find notes. Networking is an awesome one. So this one was originated by a note investor. So I think I originally found him through a Facebook group. So connected with him that way. And I bought a deal from him before. So we have a previous relationship as well. So networking within the note investor space is a big one. Also, I market to asset managers of medium to small banks. So banks themselves will sell their mortgages off as well, especially if it's a non-performing note, meaning they're not paying a bank, especially a bank, they're a well-oiled machine. They really don't want to deal with those headaches. They would rather pass it off to an investor who can really bring some value out of it, get it off their books. So yeah, networking and marketing to small and medium-sized banks. And I feel like there was a third one I was going to say. I don't know, but yeah, networking and banks, funds. So there are bigger funds that basically are doing the same thing. But the bigger the fund you are, like the more kind of laser point focused you have to be. So there might be some loans on a funds book where it's either too small for them, but it was part of the bucket or the tape, we call it a tape, the tape that they just bought, it's too small for them, or it's not in there. Something that doesn't fit their buy box, they'll sell those off to more boutique investor like myself. So funds, banks, and other note investors where you can find these deals. If you're on this call and you're like, you don't want to fund this, but you're like, I want to actively find some notes, I would say go on LinkedIn. If you just type in the search chat, type note investor, or you can type in like asset manager. Go with note investor first. Just type in real estate note investor in the search bar. Then you'll find a bunch of people that are note investors. It says that in their title. Just start connecting with those people, messaging them saying, hey, do you have anything you want to sell? I'm looking to buy notes. So if you want to actively get in the note space, then that could be a good starting place.
Yeah, don't do that, please.
Okay, sorry, Stephen. Don't do that.
I'm just playing. But get educated first, because you can make too many mistakes where you're going to lose money. But I would invest with. And Paul, I'm sure you're willing, if somebody comes on board with you, to kind of work with them ongoing too. I don't know that Absolutely. For a fact, but I'm sure you're looking to build relationships. So, sure. I'm sure Paul can show you a little bit more about what he's doing while you guys are investing together and buying these. And like he said, this isn't, a one-time thing. He has other deals already in the pipeline, performing and non-performing. So you can learn about that. And if not that, go to somebody like Kevin Shortell, let him really teach you the business. But this is awesome, Paul. I love it, man. It's, I think this is a great addition to the Private Money Club. And I can't wait to see, I'm sure you'll get this funded.
Awesome.
I'm sure somebody on here is going to reaching out. So if you guys want to talk to Paul, you can reach out to him right on Private Money Club. I put his contact info over in the chat box. You can see it on the screen right there. So like I said, just, start the conversation. So is that your cell phone? Can they text you?
Yeah, they can text me. That goes right to my mobile. And
I would say, text or email, you guys set up a call, hop on the phone or a Zoom and chat, just have the conversation.
Cool. Yeah. And kind of like what you mentioned before, even if this one's coming down the pipe quickly, June 8th, let's talk this week if you're interested in this deal. But even if that doesn't work, whether it's not a good time frame for you or you have you don't have quite enough to fund this one. Let's talk anyway. And yeah, we'll get something going in the future. So love to connect with you, even if this isn't a fit right now.
All right, cool. Yeah, looks like Freddie and Donna both are going to be reaching out to you. I'm sure you'll have a bunch
Cool,
of people.
Freddie.
So,
Looking forward to meeting you.
all right, cool, Paul. Well, I appreciate your time and I appreciate you coming on, being part of the Private Money Club. Can't wait to keep working with you and talking more about these. So yeah, keep me updated how things are going. And definitely once you get more pools or more notes coming in, let's bring you back on. And now that we've kind of got some of the basics out, next time you come on, we can get in a little more detail about the deals, and maybe people by then will have some more questions and things like that, and we'll go from there with it. So
sounds like
appreciate everybody being on, but take it home, Paul.
Wow. Yeah. Great talking with you guys. Let's connect. Stephen, really appreciate the opportunity, and yeah, looking forward to the future.
All right, cool, man. I'm just having some fun. We our Money Club Mondays, we have a great little group of people that are on this thing every Monday. So, all right, cool. Well, everybody have a great week. Let me know if you guys need anything. Paul, we'll talk soon. And thanks, everybody.
Awesome.
See you soon.
Sounds good.
All right, see you guys. Bye.
Bye.